The past few weeks have been stressful for everyone, especially for investors. Everyone talks about a recession. Trump has introduced one extreme tariff after another, raising concerns about the economy. As a result, the stock market entered a correction and dropped sharply over the past 2 weeks. Major banks and financial institutions have lowered their GDP forecasts and have increased the probability of a recession. But let's be honest, no one truly knows what will happen. No one has ever been able to predict the exact start of a recession. The stock market's peak or bottom is only clear once it's in the past. The main reason behind the market turmoil and growing economic fears is Trump's aggressive tariff strategy. It's not that people didn't know about these tariffs. Trump used them during his first term and repeatedly talked about them during his campaign. The real issue? No one actually thought he would follow through. Yet in just a few weeks, he slapped tariffs on Canada, Mexico, and China, and now he's threatening the European Union with more tariffs. And those countries retaliated with tariffs, causing potential trade war fears. That's what caught investors, businesses, and consumers off guard, causing widespread uncertainty. Let's take a quick look at a breakdown of the tariffs that have recently gone into effect. On March 4th, a 25% tariff on goods from Canada and Mexico and a 10% tariff on Canadian energy products took effect. However, on March 6th, Trump delayed tariffs on USMCA-compliant goods and Canadian oil and gas until April 2nd. On the same day, a 10% tariff on all Chinese imports was introduced, bringing total tariffs on Chinese products to 20%. On March 12th, a 25% tariff on steel and aluminum imports from all countries officially went into effect. On March 13th, Trump threatened a 200% tariff on EU alcohol, after first telling reporters on February 2 that tariffs on the European Union were coming pretty soon. The question is how big and important these tariffs are. Well, during Trump's first term, tariffs were imposed on $380 billion worth of products in 2018 and 2019. Now, under his second term, tariffs already impact over $1 trillion in imports. And if exemptions for Canada and Mexico expire in April, that number will jump to $1.4 trillion. These tariffs are some of the most aggressive trade measures in U.S. history. Tax Foundation estimates the average tariff rate on all imports will rise from 2.5% in 2024 to 8.4%, the highest average rate since 1946. Right now, the best approach is to assess how these tariffs could impact the economy and determine if there are real risks ahead. But even that is just an expectation. And given Trump's history of changing course quickly, these tariffs may not even stay in place for long. Okay, let's first try to understand why Trump is imposing these tariffs in the first place, and whether he can actually achieve what he wants. First, reducing trade deficits. Trump argues that the U.S. has long been at a disadvantage in trade, running large deficits with countries like China and Mexico. By imposing tariffs, he wants to reduce imports and encourage domestic production, theoretically lowering the trade deficit. Tariffs make imported goods more expensive, so people and businesses in the U.S. may buy fewer foreign products and more American-made ones. This can lead to fewer imports and potentially more exports if U.S. industries grow, helping to reduce the gap between what the U.S. imports and exports. Second, bringing manufacturing back to the U.S. Higher tariffs on foreign goods make imports more expensive. This is meant to push companies to manufacture in the U.S. rather than overseas, creating American jobs and boosting industrial output. Trump also believes that some foreign companies might set up factories in the U.S. to avoid tariffs. This sounds promising, but in reality, it takes a lot of time. Building factories, hiring workers, and setting up supply chains doesn't happen overnight. It can take years. In the short term, businesses might just pass the higher costs to consumers or look for suppliers in other low-cost countries instead of moving production to the U.S. So, while tariffs could bring back some manufacturing, the impact would likely be slow and uncertain. Third, delivering billions in new federal revenue. Trump argues that tariffs bring in billions of dollars in new federal revenue, which could help cover government spending or make up for tax cuts in other areas. Tax Foundation estimates that a 10% universal tariff would raise $2 trillion from 2025 through 2034, before factoring in how the taxes would shrink the U.S. economy. While Goldman Sachs expects that a 25% tariff on Canada and Mexico, along with a 10% tax on Chinese imports, would generate just under $300 billion in tariff revenue per year. Yeah, this is sweet, but the key word here is before factoring in how the taxes would shrink the U.S. economy. In theory, he is right. But tariffs also come with downsides, slow down parts of the economy, and can hurt economic growth. Whether they truly help or hurt depends on how businesses and consumers react, making this a very uncertain strategy. Fourth, pressuring other trade partners. Trump sees tariffs as a negotiation tool to push other countries into making trade deals that he believes are fairer for the U.S. He argues that for years, some countries have taken advantage of the U.S. by imposing higher tariffs on American goods, setting up trade barriers, or subsidizing their own industries, making it harder for American businesses to compete. With tariffs, Trump is trying to pressure these countries to lower their own trade restrictions and agree to new deals that give U.S. companies better access to their markets. But tariffs aren't just about trade. Trump also uses them as a threat to push countries into action on other issues. For example, he warned Canada and Mexico that they would face higher tariffs if they didn't do more to address migration and drug trafficking. By linking tariffs to non-trade issues, he hopes to get other governments to take his demands more seriously. And finally, there are other reasons why Trump supports tariffs. For example, he argues that relying too much on foreign suppliers, especially from China, could create long-term risks for key industries like steel, semiconductors, and pharmaceuticals, threatening the national security. Additionally, his tough trade stance may also serve a political purpose, reinforcing his image as a leader who stands up to China and fights to protect American workers. Overall, Trump's tariffs might bring some benefits, like extra government revenue and possibly better trade deals with certain countries. But the economic impact is likely to be negative. Higher costs will hit consumers the hardest, businesses will struggle with rising expenses, and retaliatory tariffs could hurt U.S. exports. While the strategy may work in some areas, the broader effect on the economy will likely do more harm than good. Having said that, let's now understand how tariffs can negatively impact the economy. First, consumer prices and the inflation rate are likely to rise. With nearly everything the U.S. imports from China, Mexico, and Canada now facing tariffs, the cost of everyday goods is bound to rise. These three nations account for over 40% of U.S. imports, meaning a huge chunk of what Americans buy will be affected. Importers often pass these additional costs onto consumers in the form of higher prices. An analysis by the Peterson Institute for International Economics found that Trump's tariffs could cost the typical U.S. household an extra $2,600 per year as businesses pass the higher costs onto consumers. Agricultural products are expected to be among the hardest hit by tariffs. For example, Mexico is the largest supplier of fruits and vegetables to the U.S., while Canada dominates in grain, livestock, and meats. Let's look at some interesting numbers. According to the U.S. International Trade Administration, 51% of U.S. agricultural imports in 2024, worth $27 billion, came from Mexico and Canada. 34% of livestock and livestock products were sourced from these two countries. 38% of processed food imports came from Canada and Mexico. Mexico supplied 40% of all U.S. beverage and tobacco imports. The U.S. also imported $15 billion in alcoholic beverages from the EU, which could potentially face 200% tariffs under Trump's trade plan. Target CEO Brian Cornell said in an interview with CNBC that Trump's tariffs on Mexico may force the company to raise prices on fruits and vegetables. Consumer electronics and home appliances are also expected to be hit hard by tariffs, affecting everything from cell phones, TVs, and laptops to video game consoles, monitors, refrigerators, and washing machines, along with the components that power them. China and Mexico are the top suppliers of computer and electronic products, accounting for 40% of U.S. imports in this category. Electrical equipment and appliances are also heavily dependent on these two countries, which supply 52% of imports. Cars sold in America won't be spared from tariffs either. With a 25% tariff on auto imports set to take effect on April 2nd, car prices are expected to rise quickly. As one automotive economist mentioned, there's probably not a vehicle on the market today that wouldn't be affected in some form or fashion by tariffs. He thinks prices would start to change in the 1 to 2 weeks after the tariffs go into effect. Meanwhile, according to the Anderson Economic Group, the cost to build a crossover utility vehicle in the U.S. is expected to rise by at least $4,000. For electric vehicles, the impact is even more pronounced, with price increases reaching as high as $12,000 per vehicle. It is really hard to tell how much prices will go up. Businesses will try to absorb some costs, adjust supply chains, or use existing inventory to delay price hikes. But over time, higher import costs will reach consumers, especially in sectors with tight profit margins, like groceries. Second, job cuts and high unemployment. Tariffs are often justified as a way to protect domestic producers, encouraging onshore production and creating new jobs. In theory, this sounds beneficial, but the reality is more complicated. Industries that depend on imported materials will face higher production costs, which could force them to cut jobs or slow hiring. While bringing production back to the US could create jobs, the process takes years. Building factories, hiring workers, and reorganizing supply chains isn't quick or easy. Meanwhile, the immediate impact of tariffs will be felt by import-dependent businesses, which will see costs rise right away. Additionally, retaliatory tariffs from affected countries might decrease demand for US exports, further impacting employment even in certain export-driven sectors. When people fear losing their jobs or see wages stagnating, they spend less, especially on big purchases like cars, homes, and electronics. Lower spending slows down economic growth and creates a ripple effect, hurting businesses that depend on consumer demand, like retail stores, restaurants, and travel. And that brings us to the next point, which is reduced business investments and production. When trade policies keep changing, businesses face a lot of uncertainty. If a company isn't sure what its costs will be next year, or even next month, it becomes too risky to make big financial commitments. With the tariffs in effect, and even more about to be implemented soon, companies may delay or cancel investments in new factories, equipment, or expansion plans. Many U.S. businesses rely on global supply chains, meaning parts and materials come from multiple countries before a final product is made. With tariffs raising costs on imports, companies may scramble to find alternative suppliers, but that's not that easy. Finding new suppliers takes time and often means higher costs. Some industries, like electronics and auto manufacturing, are deeply integrated with China, Mexico, and Canada, making supply chain shifts extremely difficult and expensive. And operational inefficiencies arise as companies try to adjust, leading to delays, increased costs, and lower productivity. An extreme level of tariffs that we see today create an unpredictable business environment. And when companies are uncertain about their future costs, they play it safe, which often means less investment, fewer jobs, and slower economic growth. Now, the main question on everyone's mind these days is, can a recession happen anytime soon? Everything we've talked about so far points in one direction: a higher risk of recession. And lately, we've been hearing the term Trumpcession pop up more and more. Even Donald Trump himself didn't rule out the possibility of a recession and higher inflation, admitting that his trade policies are causing uncertainty and market turbulence. A lot of major financial institutions adjusted their recession forecasts upward and shared alarming views. Goldman Sachs raised its 12-month recession probability to 20% from 15% and warned it could go even higher if Trump sticks to his tariff strategy despite worsening economic data. Mark Zandi, chief economist at Moody's, now sees the risk at 35%, more than double what he estimated at the start of the year. He believes a recession is likely if tariffs stay in place for months. Morgan Stanley now estimates a 20 to 25% chance of recession, warning that tariffs could push inflation even higher. JP Morgan Chase took the most dramatic stance, putting the odds at 40%, citing extreme U.S. policies as the key factor. But how would Fed react if the tariffs affect the economy as expected? In an economic downturn, the Fed would normally lower interest rates to boost growth and support jobs, since one of its main goals is to keep unemployment low while managing inflation. But if tariffs push prices higher, the Fed may have to keep interest rates high to control rising prices. In fact, this week on Wednesday, Fed held interest rates steady, downgraded its outlook for economic growth, and raised its inflation projection. Fed now see the economy accelerating at just a 1.7% pace this year, down 0.4 percentage point from the last projection in December, and core prices growing at a 2.8% annual pace, up 0.3 percentage point from the previous estimate. Fed Chairman Jeremy Powell noted that there had been a moderation in consumer spending, and it anticipates that tariffs could put upward pressure on prices. He added that if the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. So, we could be heading into a double trouble scenario, a slowing economy and rising inflation at the same time. And if the Fed is forced to choose between fighting inflation or stimulating growth, history tells us they'll choose to fight inflation first, which could make an economic slowdown even more painful. And that led to even more scary scenario, a stagflation. A stagflation happens when prices keep rising, but the economy slows down, a situation that we just described. If inflation rises while growth stalls, the Fed may have to keep interest rates high to fight inflation, making things even tougher for businesses and workers. Stagflation is rare, but very painful when it happens. And the best way to handle it is to avoid getting there in the first place. Whether this turns into full-blown stagflation depends on how long tariffs stay in place and how companies and consumers react. For now, uncertainty is high, and the risks are growing. I know this all sounds very scary, but here's the thing. No one really knows how long these tariffs will last. Maybe they're just a temporary bargaining tool. Trump has a history of changing course, sometimes delaying tariffs, sometimes extending deadlines, and sometimes scrapping them altogether after a few months. So while the risks are rising, it's still uncertain whether a full-blown recession is on the way. Yes, economic data and logic tell us to be cautious, but we've seen this before. In early to mid-2024, recession warnings were everywhere. The stock market corrected multiple times, and things looked shaky. But by the end of the year, the market roared back, delivering one of its best years ever, and consumer confidence surged. Could this be another one of those cycles? Maybe. But in the end, it all depends on Trump's next move. The best thing we can do is stay prepared for all scenarios, watch the data, and be ready to adapt, because when it comes to Trump's trade policies, anything can happen. I hope you enjoyed this video. If you did, one of the best ways to support the channel is by hitting the subscribe button, and even better, check out some of my other videos. See you in the next one.